Hello dummies and welcome back. In this video we're going to see a real-world example of how the equity bridge is made. Questions about common items included in an equity bridge and how you go from enterprise value to equity value appear often in more advanced private equity interviews. So here you find a simple explanation to understand an early concept. If you enjoy our video, like and subscribe to the channel as more will be uploaded soon, and leave a comment with your feedback and what you are interested in exploring more deeply. First of all, to give you a refresh, in our previous video linked down below, we explained that the equity bridge is essentially what connects the enterprise value of a company to its equity value. Why is it important? Well, since in a transaction the equity value is the money sellers are going to cash in for the sale of their shares, this number is a fundamental element in the negotiation process. So the elements included in the equity bridge could be divided in three buckets. First, the reported figures. Second, adjustments deriving from due diligence and the sellers or the management. Third, adjustment from the buyer. So let's see each one of them more in depth. The first element you subtract is the reported net financial debt that you can easily find looking at a financial statement where the net financial debt is the result of what is left after using all the available cash to pay off existing financial debts. In the case presented here, we have only 2 million of cash available in our bank account, while we have bank loans for 18 millions. This means that with the existing cash, we could only repay 2 millions, being left with 16 millions that should be therefore deducted from the enterprise value. The second element are the adjustments that emerge from the financial due diligence and discussion with the management or the sellers. Here the goal is to define all the elements that could represent additional financial obligations requiring cash outs in the future. To make a comparison, imagine you are buying a new house. You pay your price and move happily inside your new place. But then after 1 month, the condo manager comes and asks you for an additional 100,000 euro because the previous owner did not pay any of his duties through the years. And they also agreed on some renovation to which you should now contribute. You're quite disappointed, right? As you would have liked to know those liabilities before buying. Well, here the concept is the same, as the buyer is trying to consider liabilities before they manifest themselves in order to consider them in the context of the transaction. In the case presented here, you have a short list of the most common adjustments that you can cross by. First, we have liabilities towards a factoring without recourse provided that due to its nature do not appear on the balance sheet but should be factored in the equation as it contributes to cash generation. Then we have income taxes that still have to be paid by the sellers since they are related to the management period. Moving on to overdue trade payables that after 90 days are considered financial in nature since by not paying my suppliers we can say that I am financing my operation via the cash retained through the delay of their payment. Next to capex payables, those are capex committed for which I have signed a contract maybe for a new plant or a new expensive machine, but that I have not paid yet and so will remain as a liability for the acquirer. Leasing liabilities are shown here as well in case your accounting system does not include them in the net financial debt calculation. And finally, adjustments related to the M&A activities are similar to CapEx commitment, since they represent agreements that you already have signed in relation to an acquisition of other companies like add-ons, but that did not result in a cash out yet. A typical example could be the presence of an earnout. So those are just some examples of the most common elements that will be included and derived from the sell side analysis. To them, further ones could be added by the buyer. And so we move to our last section. Here you find additional elements that were not cited by management or the due diligence, but that we want to include in the calculation as they represent as well potential liabilities. First, we have the severance fund, which is the one related to employees leaving the company. This is the very unlikely and very unfortunate event that all the employees resign. Those are money that we owe them. A certain percentage is therefore usually included in the calculation to factor in the risk of such withdrawal from the company's finances. Next, we find net working capital seasonality, which is a wide topic that we will cover in another series. But to cut it shortly, let's say you want to consider an average level of net working capital in order to even out the positive or negative effects of seasonality on the company cash balance. So the buyer's adjustment could vary widely and depending upon first what is already included in the due diligence and second the perception of the risk that the buyer wants to take into account in the transaction. And what is left after accounting for all those items? Well, finally we arrive to the equity value, what our sellers will receive for their shares. If you enjoyed the video, like it and subscribe to the channel as more content will be uploaded soon. Leave us a comment with what you wish we explain and see you in the next video. Ciao!